In this video, I'm going to look at multinationals, and in particular, I'm going to look at some of the strategies multinationals might take in an international environment. And this will include factors such as regulatory arbitrage, tax arbitrage, and how these companies shift profits or at least shift revenues across borders. Multinationals tautologically operate across multiple countries. This creates both challenges but also opportunities. The challenges involve needing to navigate multiple different regulatory environments. So, for example, needing to deal with political risk and country risk, needing to deal with the complexity of multiple different taxation and regulatory environments and jurisdictions they might operate in. And it can be challenging in that respect. However, there can be opportunities. Those opportunities have been restricted over time, but can enable companies to perhaps shift profits across borders, which multinationals are more uniquely able to do than our domestic companies. Now, clearly, some of these strategies have become decreasingly useful over time, but nevertheless, it's worth covering what they are and why it is that regulators have become concerned about many of these strategies, and quite rightly in many cases. And some of these strategies can involve transfer pricing games. They can involve, for example, the charging of fees and royalties to subsidiaries in a way to try to transfer money across borders. And these multinationals can also engage in various different practices, such as regulatory arbitrage, which, for example, might occur when one is deciding which exchange to list on. Now, clearly, these multinationals do face challenges, however. Those challenges can involve exchange controls. They can involve the cost of obtaining information across borders, the cost of complying with multiple different regulatory regimes. Sometimes it can be more challenging to deal with corrupt regimes as well. So they have to face those political risks, which raise the prospect that the valuation or the cash flows from a project might be lower than was ultimately hoped for. So in terms of arbitrage opportunities for multinationals, and by here I'm meaning regulatory arbitrage type scenarios, as opposed to arbitrage in that strictly financial sense of the word, we can look at different types of things multinationals might do in a multinational environment. So for example, they might engage in tax arbitrage, which would involve setting up subsidiaries in locations that have relatively more beneficial tax rates. Now, the exact choice here is going to depend on where you have your expenses, and in particular, a multinational might decide to put a high expense subsidiary into an environment with a high tax rate and have its revenues coming into an environment that has a lower tax rate. And in some cases, those multinationals can negotiate with governments for preferential tax treatments, as has reportedly been the case in Ireland and has allegedly been the case in Singapore. So tax arbitrage can be one thing that multinationals might engage in. They might also engage in financial market arbitrage. Now that financial market arbitrage could be in the pure arbitrage sense of the word. By virtue of having multinational operations, it might be easier for multinationals to take advantage of pricing imperfections and therefore obtain a degree of profits if they want to engage in those types of financial transactions. They could, of course, simply take advantage of market imperfections, broadly speaking, which might enable them to get access to better rates on debt if they're able to do this by virtue of operating across multiple countries. They might also engage in regulatory system arbitrage. Now, what that effectively means is choosing the regulatory environment that is more preferential to that firm. Now, that could be either at the subsidiary level or at the headquarters level. But at any rate, these multinationals might choose to operate in the environment that gives them the best regulation. So, for example, in the environment of cross-listing, the multinational might decide to list in a market that has regulations it prefers. For example, list on a stock exchange that enables dual-class share structures, or enables poison pills, or enables things of that nature, which might be a motivation for choosing one exchange over another. So if we have a look at this, these considerations have been at play. So this graph is basically just showing the proportion of deals that are cross-border in Australia, and it's looking at the representativeness of cross-border deals and how important they've become over time. Now, cross-border deals don't account for the majority of deals in Australia, but these cross-border takeovers have clearly become important. So, for example, in 2019, we can see that almost a quarter of deals were cross-border takeovers. Obviously, that fluctuates quite a bit based on market conditions. In more bullish markets, you tend to see more cross-border takeovers than in less bullish or in more bearish markets. So, for example, will fluctuate quite a bit. And we can see that it fluctuates quite a lot, but it still is quite an important proportion of all cross-border deals. This suggests these multinationals might be engaging in a degree of regulatory arbitrage by acquiring overseas, or they could be acquiring overseas to obtain resources or assets in those cross-border takeovers. There are myriad reasons for doing a cross-border transaction, one of which can include selecting into a regulatory environment that is deemed to be more preferential. This can also be at play when we look at corporate tax rates, which are often quite different across countries. For example, Australia has historically had a higher corporate tax rate than the United States, which suggests that an organization might set up subsidiaries in order to take advantage of this. Now, you can also see as well that Australia's corporate tax rate has fluctuated quite a bit over time. It's fluctuated from being exorbitantly high back in 1981, nearly 50%, to being 30% in 2009, and it has decreased thereafter. Similarly, in the United States, many countries have seen this regulatory environment and adjusted their corporate tax rates in order to attract companies into that environment. So regulatory arbitrage can exist at the tax level, where companies might set up subsidiaries in higher tax environments if they're going to have a lot of expenses, or conversely if those subsidiaries will have low expenses and high revenues. And similarly, the multinational might choose its headquarter location in order to take advantage of these taxation differences. In short, taxation differences can affect where companies and where multinationals set up their operations and also where they set up their headquarters. And they can have on-flowing implications for things such as transfer pricing, the charging of royalties from the parent company to the subsidiary, and various other expense shifting strategies that might go on. So when we think about these intercompany fund flow mechanisms, there are quite a few that exist, some of which are more legitimate than are others. So for example, there are reinvoicing centers, which enable that multinational to invoice from a different location than the sale appears to take place. We've got fees and royalties, whereby the parent company charges fees and royalties to subsidiaries in order to extract expenses from those subsidiaries. Basically what they're doing is they're extracting money from the subsidiary, charging an expense to that subsidiary, and therefore potentially reducing the taxable income it would face. They can be leading and lagging, which is effectively delaying or accelerating the receipt of payables. It's effectively the provision of a low interest or interest-free loan to subsidiaries, which a multinational is more apt to do than a purely domestic company, purely by virtue of the fact that it's running multiple subsidiaries. We have dividend payments, which are relatively straightforward and involve the payment of dividends from, say, a subsidiary to the parent company. Ordinarily, that's going to involve ordinary taxation implications. And you can also have transfer pricing. Now, transfer pricing involves shifting goods between subsidiaries, and at each shift, those goods need to be priced internally. That pricing internally makes a lot of sense from an accounting perspective. You need to keep each corporation separate because each one is its own separate legal person. And it's important to keep track of the books there. So if you shift a good from company A to company B, both of which are subsidiaries of the parent, you still need to charge company A, or company B rather, for the shift of those goods. So transfer pricing plays an important and legitimate role, but multinationals sometimes take it too far and attempt to use it to reduce their taxable income in a way that is not legitimate. And we're going to see how some multinationals might in fact do this. So in terms of transfer pricing is one of the most effective ways to perhaps deal with the accounting problem that exists when you have a multinational organization. Now, the accounting problem that exists is ostensibly that when you have multiple subsidiaries, oftentimes one subsidiary will manufacture a good and then the next subsidiary is going to develop it into something else. So there might be a vertical chain of subsidiaries creating the finished product. But when you move the product from one subsidiary to the next, you need to properly account for that. You need to give subsidiary A credit for the thing they've produced, and you need to charge subsidiary B for having purchased it. Transfer pricing refers to the pricing of that transfer of that good, or hypothetically a service, between subsidiaries. Now, when done properly, it's going to be charging a fair value for that good. It would be at the market value that is appropriate for the item. However, when it's not done properly, one can play around with these transfer prices in a way that is perhaps sometimes illegal, but also might involve the reduction of taxable income. Oftentimes, tax regulators have taken active steps to reduce the possibility of doing this, and this is for good reason. to try to avoid multinationals from shirking their taxation responsibilities. But it's important to know how this operates so that we know why regulators have become so concerned about transfer pricing and the implications that it might have. Now let's see how transfer pricing works. Now suppose we have two affiliates for a multinational, A and B. Now both of these are wholly owned by the parent company. Now subsidiary A, it manufactures things and then it on-sells it to subsidiary B for subsidiary B to sell to a broader market. It could be that, for example, subsidiary B operates in a different location and therefore sells to a different customer base. What we do need to do is we need to record the price or value of that transfer of the goods between A and B. The reason we need to do this is we need to give credit to the company that has manufactured the goods, and we need to expense the company that has taken the goods. Otherwise, you end up with a very messy transfer between subsidiaries, and you can't account for who has actually performed better. So suppose these subsidiaries are doing circuit boards. So affiliate A produces circuit boards. It can produce them at a cost of $10 per circuit board. Now suppose it on-sells them, and we're going to look at the market price. So suppose the market price is $15 a circuit board. We're going to have a $5 difference here. And suppose as well there are 100,000 circuit boards. Let's see what might happen here. So the cost of goods sold for affiliate A will be 1,000. So $10 multiplied by 100,000, and I'm taking off some zeros just so that it's easy to see here. So we've got the cost of goods sold of 1,000. They're sold at $15, so therefore your revenue ends up being 1,500. Now the transfer price here is the $15 per circuit board. So the new cost of goods sold for affiliate B becomes $1,500. Then suppose affiliate B is able to on-sell them for $22 a piece. Its revenue then becomes $2,200. Now we can see what happens in terms of the taxation and also the after-tax profit. So the gross profit for affiliate B will be $500, and the gross profit for affiliate B will be $700. So we might have some other expenses that go on, so let's just assume that's $100 for each of these. Now then we've got an income before tax. So for example, $400 for affiliate A, $600 for affiliate B. Now suppose the tax rates are different for A and B. Suppose the tax rate for A is 30% and the tax rate for B is 50%. What do we have here? Well, it means that our taxes for A are $120, which is 30% multiplied by 400. The taxes for B are $300, which is 50% multiplied by 600. So therefore, our after-tax profit for A is going to be $280, and the after-tax profit for B is going to be $300 rather. So what we can then see is we're going to get combined accounts. But what we're more interested in, rather than the combined accounts per se, is what happens when you start playing with the costs of goods sold here, and in particular price of the underlying circuit boards that are being transferred between the two entities. And would it be better to have a higher price or better to have a lower price? And you can see what might be the case. So let's have a look at this. So suppose we have a low markup. The low markup is effectively where we're selling the good for, say, just this $1,500. And we already saw the revenues and the after-tax profits that would exist. This was our prior example, where we had this low markup, the $15 markup when you're transferring the good. Suppose you increase that markup, so you basically make the good more expensive for company B. So in that case, company B needs to pay more for the goods. We're going to see that that would benefit the multinational here. It would benefit the multinational because company B is in a high tax environment. So therefore, reducing its taxable income is beneficial to the parent when it's consolidating the accounts. And it's also beneficial to company A because company A is in the lower tax regime. So let's see how that might operate. So suppose our transfer price is now $18 instead of the $15 from before. In this case, company A would get revenue of $1,800, but company B will have COGS of $1,800 as well. So that means that company A now has a higher pre-tax income. Company B has a lower pre-tax income. So company A's gross profit is $800. Now company B's gross profit is $400. Before it was $700, now it's $400. Now let's keep the other expenses constant as before, so $100 for the other expenses for each of them. So therefore the pre-tax income for company A is going to now be $700, whereas before it was $400. The pre-tax income for company B is now going to be 300, whereas before it was 600. So when we have taxes added on here, the tax rate for company A is lower than it is for company B. So our taxes for company A are 210, being 30% of 700, and they're 150, being 50% of 300. So therefore, our after-tax income is now 490 for company A and 150 for company B. Now what you'll notice is when we add these together, it's actually better off in this high markup environment. It's better off because now the consolidated income is going to be about $640, whereas before the consolidated income was $580. So the company is now significantly better off by virtue of playing with these markup prices to try to game the high tax environments. Now clearly governments have tried to prevent this from occurring, and regulators generally frown upon this type of practice, and they will often heavily scrutinize transfer prices. But nevertheless, it's important to know about why regulators have become concerned in this context. Now, in terms of general transfer pricing policies, we can basically see that if the tax rate for company A were higher than the tax rate for company B, then you would set the transfer price as low as possible. The reason you would do that is you want to avoid the profits being in company A. Now, the converse is the case with company B. So suppose the tax rate for company B is above that of company A, then you would set the transfer price as high as possible. So your revenues were being accrued for company A rather than for company B. So you can use those as general rules of thumb. Of course, it's best to know the intuition behind it, but clearly there are some general principles that often exist that companies might try to adhere to. The profits are then being shifted in order to get them into the lower tax regime as compared to the higher tax regime. And multinationals are more uniquely placed to do this because multinationals existing across multiple countries are able to transfer the goods across those jurisdictions. Now, the question then becomes, what if there are tariffs? Now, suppose there are tariffs being paid that can clearly influence things, because when goods are transferred across borders, there might be a tariff that's payable. So one is going to need to look at the net effect of those tariffs when one is assessing this. And sometimes this can benefit you and sometimes it can harm you. So suppose affiliate B has to pay tariffs or import duties. Now these are set as a percentage of the value of the imported goods. So suppose they're set at 10%. Now what this means is we have two moving parts. We have the tax rates and the tariffs. And when you have to pay a tariff on the goods being imported, it can create a disincentive to set a higher transfer price. This is because you need to pay a higher price or a higher cost due to those tariffs when you bring the goods from company A to company B. Now these tariffs are tax deductible, but they still need to be considered. And we need to consider what impact is that going to have on the cash flows that might arise. Now effectively what we are saying here is the higher the tariff relative to the income tax differential, the more likely it is that there's going to be a low transfer price being desirable. The intuition behind that is as the tariff gets higher and higher, you get a higher and higher cost on those costs being transferred. So as that tariff becomes higher, it's less desirable to set a high transfer price because you're going to be paying a high amount in the form of that tariff. So let's have a look at our example again here. So suppose we have tariffs here of that 10%. So in that case, we now have the tariffs being imposed. So suppose we have our low markup environment. Our low markup environment involved the transfer price of $15. In that case, at the $15 transfer price, we'd have $150 of tariffs being payable on our figures from before. Now we can see what that does to our after-tax profits. So in this case, the main change is the affiliate B. Now affiliate B used to have $700 as its after-tax profit, as a pre-tax profit rather. Now it's only $550. Now on those expenses of $100 from before, our pre-tax income ends up becoming $450. So therefore, our taxes are now 50% of $450, which is $225. So our net income is now $225. So when we consolidate all of this together, we end up with $505 being our total consolidated net income. Now let's compare this to the high markup environment. Under the high markup scenario, we had a markup price of $18. Now that means you'll need to pay $180 as your tariff. Now that means you have this additional expense. Alright, so what then happens? Well, our gross profit is then reduced. Our gross profit then becomes 220. It becomes 220 because we have our sale price of $22 per good. Then we subtract off the transfer price for the good being transferred, which is $1,800. Then we subtract off our tariff of $180. So our gross profit is now only $220. Our taxes are 50%, so our tax is going to be the 50% of the net income here, or the income before taxes rather. So if we have our other costs of 100, then our pre-tax income is 120. Our taxes are 600, or 60 rather, being 50% of 120. So our after-tax income is 60. So what then happens here? Well, our total consolidated net income is 490 plus 60 equals 550. So we're still better off with this high markup here, but we're less well off than we were beforehand, suggesting when the tariffs are imposed, the benefits of these transfer pricing start to decrease. Now, the next concept is reinvoicing centers. Reinvoicing centers are relatively simple to understand. A reinvoicing center usually is based in a low tax environment. Usually what would happen here is you have effectively a sales office in a domicile. However, everything is invoiced from the low tax environment. So all of the revenues go to that low tax country. And this then reduces the taxable income that the firm might face, because all of those revenues are being invoiced in the low tax environment and therefore being taxed in that low tax environment. Now clearly this runs into legality issues. Regulators have heavily scrutinized this and have helped to prevent reinvoicing centers being used in egregious manners. Now clearly these reinvoicing centers are more legitimate when there's something like an online good that is being sold internationally. They're much less legitimate when there's a local sales office which then happens to invoice people using a foreign subsidiary. So it's basically a matter of degree as to how legitimate these reinvoicing centers are. But it's important to note that regulators have tried to prevent these being used in egregious or problematic manners. We also have fees and royalties. Now, fees and royalties basically are a situation where you have a parent company and it charges a fee to the subsidiaries. That fee might be a licensing fee or a brand fee or something like that. The underlying goal here is those subsidiaries might be in high tax environments. So what the parent company might do is it might try to charge an expense to those subsidiaries with the underlying goal of increasing the expenses for those subsidiaries and effectively transferring that money to the parent company before taxes are paid. This is then going to reduce the taxable income of that subsidiary, reduce the taxes paid, and your consolidated reports or your consolidated financials would look better. Now, clearly this can be problematic from a regulatory perspective. Regulators tend to frown upon these fees and royalties being charged, and the regulators will look for whether they are legitimate. And in particular, if the multinational charges different fees and royalties or uses some abnormal calculation, then regulators will clearly intervene and try to prevent that from occurring. So obviously it can attract regulatory scrutiny. However, one can see the underlying logic for why multinationals and in particular parent companies might use fees and royalties in this type of manner. Now the next thing is leading and lagging. Now leading and lagging basically refers to the principle of trying to shift when receipts are being received, or when you have to make payments rather. So it's effectively shifting the due date of payables or receivables. The underlying goal is to shift liquidity amongst affiliates. This is done by effectively not demanding repayment for a long length of time. Now this is mainly done for liquidity reasons, and mainly done in order to enable cheap debt or cheap credit. It's not so much done for the purpose of taxation reasons, although it could be if one wanted to shift between financial reporting types. It's primarily done, of course, for the purpose of providing liquidity, particularly where a subsidiary might otherwise have difficulty borrowing at a reasonable cost in one environment. Basically, because there are financial arbitrage opportunities and/or there are financial market frictions, it might be useful to give that subsidiary access to relatively cheaper capital if there are frictions for that subsidiary otherwise raising it. So as one basic example here, we might have a normal situation. We have affiliate A and affiliate B, where you've got 90 days payables. So you effectively have to pay for things in 90 days. If you have leading, you effectively accelerate that. So the payments need to be made earlier. This might be done if one of those subsidiaries needs to get the money earlier and it's useful to have the liquidity going to company A. or company B as the case might be. So here, for example, you might have it accelerated, and then what you would end up with is you'd have these payables being shifted forward. Or you can have lagging, where you're effectively trying to lag some payables. Now here we're talking about lagging relative to the leading term. So here you would end up with those payables being paid later. So in either case, you would end up with a shifting of liquidity amongst these subsidiaries. And it's a de facto transfer for a short time period between those subsidiaries. Now clearly it needs to be repaid at some point. So it's not generally going to be a good way to reduce taxable income, but rather is done as a way to try to shift the timing that things need to be repaid. So to see why this is useful, this can shift liquidity and enables direct access to intercompany loans, and it's effectively facilitated in a way that is easy. The main reason you would do this rather than actual loans is because intercompany loans, so the actual creation of a loan literally, attracts a lot of regulatory scrutiny. It does this because that appears to be a tax avoidance mechanism. Effectively, the parent company is charging an expense to those subsidiaries, or there's an expense being charged within subsidiaries. The expense, of course, being the interest. However, when you simply delay a payable, you've de facto created a loan, but you've done this in a different way by simply not requiring payment. So, for example, if the payable previously had 30-day terms, but you allow 90 days to get that payment, you're given a 60-day loan, which can be a much cheaper way to do it than actually creating a loan per se, and will attract significantly less regulatory scrutiny. Of course, the disadvantage, if you want to call it that, is it typically won't have major implications for taxable income. It's mainly done if you want to provide liquidity. Another related advantage, therefore, is because these intercompany leading and lagging type situations don't really generate a loan, you don't generally get regulatory repercussions from doing so. Regulators generally don't frown on this practice nearly as much as they would an intercompany loan per se. Effectively, it enables you to do a more legitimate way of giving credit to a subsidiary without creating the appearance of taking advantage of difference in taxation regimes. It can generally be beneficial, therefore, particularly if there are differences in interest rates. So to give one really basic example, suppose we've got a scenario here. There's a multinational firm that's operating obviously across multiple countries. The after-tax borrowing cost and lending cost in German and US subsidiaries. The German unit owes $2 million to the US unit. Now assume the US unit is in a deficit, and the German unit has excess cash available. The timing of this payment can be changed for up to 90 days. Now, the 90 days comment here is slightly arbitrary. We're just having a time horizon that we can play with. Now, suppose we have the following borrowing rates. In the US, it's 3.8%, and Germany, 3.6%. The lending rate, 2.9% in the US, and 2.7% in Germany. So we can see kind of an effective surplus that can be generated. The surplus that is effectively generated is this German unit, and we're talking about surpluses for the parent here primarily. This German unit could either lend in its home market, or alternatively, it could effectively give money to the US market or US company early. Now, we can look at the differences in the interest rates here. The differences that are the most relevant to us are going to be the difference between this 2.7% lending rate and the 3.8% borrowing rate that is going to be most relevant. The reason for that is we have to look at what our opportunities are. With this $2 million, the German unit could either lend it in the market or it could give it to the US subsidiary. With the US firm, it could either get the money from Germany or it could borrow it. So therefore, the lending and the borrowing rates are the most relevant ones. And in particular, it's the relevant ones for the German lending rate and the US borrowing rate. So those are the ones that are the most relevant here. So therefore, we have a differential of 1.1%. This means that effectively by leading that payment, there's a 1.1% per annum interest rate differential that is relevant here. So this means that one would want to engage in a degree of leading here because it's going to be beneficial. And there's going to be clearly a net saving in this case. So the borrowing cost of this, assuming just a 360-day year for the sake of something super easy, the borrowing cost would be 3.8% multiplied by the time period, so 90 days over 360. Then we multiply that by the amount, 2 million rather. So the borrowing cost, if the US unit were to go out and actively borrow, would in this case be $19,000 in terms of the interest. Now say you have this German subsidiary, we can look at what its income would be. The income from lending will be the 2 million multiplied by this 2.7% multiplied by the 90 over 360. So that would be a quarter of a year. So that would be only 13,000 or thereabouts, or 13,500. So therefore the net saving, i.e. the net benefit of engaging in leading here, is $5,500, which is clearly beneficial. It's useful then to engage in leading because that's going to enable the best access to the cheapest cost of money. i.e. it's useful to be able to accelerate the provision of money because that's much cheaper overall than having that US unit go out and borrow. Now clearly there's the unanswered question so far of, well, how do we account for this? i.e. does the German subsidiary get some credit for it or not? Now this really depends on the nature of the multinational. If the multinational isn't really assigning credit to the individual branch managers, then it probably doesn't matter that much. However, if credit needs to be assigned to an individual subsidiary manager, this would at least need to be noted, so that you can note how he or she has performed. It's not really adequate to ignore the implicit cost of this to the German unit, but the German unit would need to be somehow compensated either directly or indirectly for this occurring. And this can be done either at the managerial level in the form of executive compensation, or if really need be, it could be recorded accounting-wise. In general terms, the firms will not account for this directly. Rather, what they would do is they would just shift the date of the payable, and it wouldn't be accounted for directly per se. i.e. it might be accounted for in executive compensation, but generally not on the firm's accounting statements. Now the next thing is dividends. Now dividends are effectively a situation where you're transferring money from a subsidiary to the parent through the provision of dividends. Generally this is going to be necessary to some extent, because if the subsidiary earns profits and doesn't pay dividends, there's often going to be withholding tax implications. So the dividends are important, and they're clearly one of the most significant transfer mechanisms between subsidiaries and parent companies. And in fact, they account for a significant portion of all remittances in the United States, amongst other countries. They're the most direct way to do this transfer, they're the simplest, they attract the least regulatory scrutiny, because if a dividend is paid, the subsidiary is paid tax, so the dividend's out of the after-tax income, and then the parent firm might also need to pay tax. So taxation is not being avoided through the use of dividends. So therefore, they're perhaps one of the most effective ways if you want to avoid regulatory problems. And it can be a way of shifting liquidity. Of course, it's an expensive way to shift liquidity, and leading and lagging is probably the cheaper and more effective way to shift liquidity, but nevertheless, it is a way to shift liquidity if that's desirable. So dividends, therefore, are important to consider. They don't really have any major advantages over anything we've otherwise talked about, but they are a key way of transferring money throughout countries. And importantly, dividends will often need to be declared, because if the subsidiary doesn't declare the dividends, they might face withholding tax. So it is still useful to have those dividends being paid. So to sum up what we've talked about, we've effectively talked about some of the advantages and disadvantages of multinationals operating across multiple regulatory regimes. We've talked about how this can give rise to financial arbitrage, it can give rise to tax arbitrage, and it can give rise to regulatory arbitrage. Those things can be beneficial to multinational organizations, with them potentially being able to shift revenues across borders and or being able to take advantage of relatively more friendly taxation regimes. But of course, all of these can attract regulatory scrutiny. And it's important that multinationals act in a legal manner, because if they were to engage in illegal or risky behavior, regulators would rightly prevent them from doing so. So one does need to operate in this legal environment. And it does raise the importance of lawyers in this situation, which itself can be a cost that multinational organizations ultimately are going to incur. Now, this can also enable multinationals to transfer money across borders, and we've talked about several mechanisms through which multinationals are able to shift money across their subsidiaries and are able to take advantage of those revenues and are able to potentially take advantage of differences in taxation regimes. But we've also talked about the fact that many of those situations can attract the ire of regulators and can be super risky for a multinational organization to engage in. So I hope this video has been informative to you. I hope it's given you a bit of an idea about multinationals and how they operate in a multinational environment and some of the ways multinationals can transfer money across borders. So thanks so much for listening in. Once again, I do hope the video has been useful for you, and I hope to see you for future videos as well. Bye.